Good afternoon. At least it's afternoon here in Dubai, and I know it's a crack of dawn in New York. And so we're incredibly grateful that our next guest has woken up very early. I know he's probably quite confused as to what time zone he's on. Dave Ernsberger, president of S&P Global Energy, this early new year 2026, in his new role leading S&P Global Energy. Every day is a different time zone. But welcome, Dave, and thanks for taking the time.
Thank you, Sean. I always know what time zone I'm in because I work on UK time only, which is a
Oh,
problem when
really?
I'm traveling. But yeah, that's right. That's what I've
Well,
decided to do.
that's a wise move, actually. Otherwise, you could be in trouble.
That's right.
Listen, we're here today as part of the Global Energy Outlook Forum. We've been going now since 7:30 a.m. Dubai time. It's about 8 or so hours, and we have been traversing across Asia, the Middle East, and now halfway through our European section. We've just been having a panel of very deep dive thinkers on all things shipping, and that's been an exciting few days for them, and getting the granular insights on the boarding of ships in the mid-Atlantic, and all sorts of flagging of ships and the unflagging of ships. And but we take this opportunity with you in the middle of this European section to sort of pull back a bit, and sort of take a global view, agnostic time zone, we would say, and to sort of look at the bigger picture of the global energy markets outlook for 2026. And I wanted just to start with, what are we leaving left behind in 2025, and what might be traveling with us into this new year? And how will all the big 2025 market trends unfold over the year ahead? You know, we've had a big, huge China inventory build in 2025, which had a big impact on the market. So we've obviously OPEC plus had a big change in strategy through the earlier part of the year, started increasing supply rather than cutting it. Looking at all the list, what do you think carries through into 2026 as a market trend that will still be with us through this year?
Yeah, thank you, Sean. We exited 2025 with a very fragile balance between price on the one hand, not just for oil, by the way, but also for natural gas, iron ore, a whole bunch of other commodity markets. So price on the one hand, and then supply and demand imbalances on the other. And I think that we will leave that fragile balance behind somehow, because those constructs cannot persist indefinitely, where supply and demand are imbalanced, prices. When I say, by the way, balance, like, the prices weren't moving very much on a headline level. Certainly, market structures have changed. We've seen a little bit of different shaping of the forward curve, which suggests that perhaps lower prices are in the near term. We're facing that situation. But at a headline level, prices have been actually very, very, very flat, for lack of a better word. And in the end, there does always need to be a reckoning, a triangulation between imbalance in supply and demand on the one hand, and price needing to move on the other. So that fragile balance that we exited 2025 on, I think, is the big thing we're going to be leaving behind. I think there are going to be some market moves to start to find the clearing levels at which the markets are going to rebalance.
And when we look at the trajectory of price, we started the year, I mean, over the course of 2025, we saw a significant oil price average decline. On the year before. 24 was $81 average on Brent, or 24 was $81 average on Brent. 2025 was a $69 average on Brent. So a $12 decline through the year of 25 over 24. How do you see the outlook for 2026 over 2025?
Yeah, certainly we project that the average price for dated Brent will be $59 a barrel in 2026, and that compares to an average price of $69 a barrel in 2025. So you can see from our own forecasts at S&P Global Energy, from our research team there, that we expect the downward trend to extend further before things rebalance. Now, on the flip side there, I would point out another thing that we might be leaving behind is tepid demand growth. Not suggesting that demand growth is going to double or triple in its rate of growth from what it was in 2025, but ultimately, you know, lower prices do tend to stimulate demand. And the world is increasingly populated by price sensitive buyers, especially in hydrocarbons and oil and natural gas. India is the poster child for opportunistic, price sensitive participation in the global hydrocarbon markets. So we're expecting oil demand to grow by about 1 million barrels a day in 2026, and that's up from closer to 700,000 barrels in 2025. So that's where the clearing level at which supply and demand rebalances is sort of what I was talking about at the start of our conversation today. Lower prices may, in our view, stimulate a demand recovery, a recovery in the rate of growth in demand, and ultimately that may begin to draw a line under some of these price declines that we would expect to see from here.
When you think about that point, Dave, I've had a few debates over the course of the day, where not to get too into the weeds of the definition of demand, but a big sort of
Oh,
disagreement
too
or
early for that kind of
discussion
thing,
point.
Sean.
I know, but that was the whole point of last year. It was is the people misread whether China's buying for storage was demand or surplus, right? And it sort of became this point of how you interpret that depended on what maybe you forecast pricing to be, and the sort of surprise ultimately. I mean, if you had a million barrel a day build in U.S. inventories, you would say, "Gosh, that's hugely bearish," and ultimately heavy on the price. But when you think of storage and think of that extra million barrels a day of demand growth in your forecast, are you including in that like 500,000 barrels a day of storage build in China as part of that 1 million, or is it consumption, just to sort of splice it apart? Or
Sure. Well, the primary driver of demand, in our view, is actual consumption of molecules. That is the primary principal driver, and we see a lot of demand being kind of moved along here by incremental consumption in Southeast Asia, for example, not just South Asia, but also Southeast Asia. United States having a bit of a rebound. Stocking and restocking and stockpiling, it does factor into ultimately the demand number as well, but probably at a lower rate than people imagine when people start to deconstruct what demand really means and how much is going into inventory. Ultimately, the percentage of what's being consumed is going into stock versus what's going into processing and ultimately being used by people. It doesn't have a massive impact on the demand number overall over a prolonged period of time. There's always interplay between when you move energy through supply chains, between when it leaves the supplier, when it arrives at its destination, and how long it's held in inventory for on both sides of that equation, by the way, and then ultimately when it's consumed. It's just a natural part. For me, it's a natural part of the supply chain.
well, it does seem to be becoming an increasing part. That's why I sort of punctuated a little bit for your insights, and in the sense of, what we carry from 2025 into 2026 seems, 2025 increasingly had a very big punctuation on energy security as
Sure.
a sort of central thesis, certainly for China, but for many other countries as well. And with energy security does seem to be coming, like you mentioned, India there, which of course is moving with significant GDP growth, but they unfortunately don't have a lot of storage. And from an energy security point of view, the idea that one could build greater capacity, that with energy security comes an increasing amount of storage. How do you think about that as you look forward?
Yeah, that's a fascinating question, Sean. China and the US are the world's two largest consumers of oil. And I think people know that. That's not an epiphany for me, for you, for the audience today. But in the end, the US and China have concluded very clearly that the best way to ensure security of supply is to build inventory. Strategic reserve on the one hand, and to kind of ensure that there are compelling commercial reserves on the other. That's the conclusion that the world's two big energy superpowers and frankly superpowers have come to. Uh, and what underlies that is the alternative is if you want to ensure your security of supply, you sort of need to have let's call it a different relationship with the countries that supply the oil in the first place. So, if you don't have your own, reserves, then you also need to put greater reliance on directly influencing your suppliers, which is a geopolitical headache, certainly. So the reason why I said it's a fascinating question is for India, because India hasn't really, for me, answered that question yet. India hasn't, as it becomes more and more of a consumer of oil and gas, is it going to build really powerful and expensive strategic reserves, or is it going to rely on influencing its suppliers? It's got to pick a path there. And look, India is at an early stage of its journey. In India, for me, is where China was about 15 years ago on its energy demand journey. But at some point in the next few years, India is going to need to decide, does it go into the storage market or does it go into the influencing market? And what's the balance going to be there?
I wanted to get your thoughts. Another big sort of not event, but it's kind of an event, maybe for us nerds in the oil sort of weeds, if you like, but nonetheless, a kind of a critical shift. The IEA made it what generally was regarded as a big reversal. They had been heavily hitting the idea of peak oil demand this decade, and then towards in the fourth quarter, sort of not totally reversed that, but ultimately pointed to a bigger time horizon. Peak oil demand pushed it out to 2050. Certainly as a scenario, I know it gets all a bit complicated whether it's a forecast or a scenario, but ultimately shifted the sort of whole thinking around peak oil demand. And we bring that into 2026 in a different way than we did come into 2025. I wonder, from your perspective, how do you think about that? How's the market? Does that change the pathway forward, do you think?
Well, there was always going to come a time where the different organizations that provide oil demand scenarios would need to snap back into some kind of an alignment because they had diverged so much post-pandemic, based on scenario work that was done during the pandemic. And, there are many folks who talk about the OPEC projections and the OPEC monthly oil market report with just as much energy as folks talk about the IEA one. Now, the IEA one is the one that is needed to kind of snap back between those two kind of, provided scenarios. Obviously, we at S&P Global do our own projections and scenarios. We have ours as well. We see oil demand peaking in the mid to late 2030s. But I guess for me, Sean, the need for these outlooks to reconverge a little bit to offer the market a certain sense of clarity about where evidence today tells us supply and demand will curve to in the future, that convergence is really important.
When you're
Because I
saying
think that,
divergence, are you principally referring to the OPEC and IEA? They had
yeah,
sort of nearly been split by nearly a
yeah,
million
yeah,
barrels of
yeah.
forecast.
There was a slightly unhelpful debate about what the difference was between a projection and a scenario and a forecast when those outlooks were really far apart. The more important question is what is likely to happen to demand in the next 10 to 15 years, and how does the market prepare for that? Those are the important questions. So IEA moving back into alignment with other organizations makes a lot of sense to me, and it needed to happen because the closer we got to some of those peak dates being way off where we really were, the more it was clear that a reassessment would need to happen, and it's good that they did.
Well, I wanted to sort of tackle on that a bit. I mean, it's interesting that you guys have put forward your forecast for demand growth this year being up to a million barrels a day. And the sort of question I wanted to get into a little bit with you was the idea that demand growth has kind of flattened down a bit. And as we said last year, 700,000 barrels, not a significant amount. And so this space in which producers and suppliers could continue to grow their own capacity and
Yeah.
compete in a growing market, now seems to be one where the demand growth is replaced by demand competition, and more competition the suppliers have for a flatter market. And that's most notably punctuated by China kind of flattening out on its oil demand. Where do you think oil producers as a whole, Gulf producers, OPEC producers should think about capacity expansion in 26 and beyond as they look at a more flatter demand growth period?
Yeah, there's a change in mindset back towards lowest cost production, exploration and development, and that's a little bit of a shift away from maybe different priorities that the industry had over the last 5 or 10 years around how it thought about developing its reserves. But in a world where supply can grow at 2 to 2.5 million barrels a day every year, and demand grows at 1 million barrels a day every year, what that drives you towards is it's the lowest cost producers, the lowest cost exporters will survive. There is an element of diversification of supply risk that will help higher cost suppliers. It will always be the case. I think that China, to some degree, the US, they will want to have a diverse slate of suppliers in a geopolitically challenged world. So that'll help offset some of the brutal economics of being a low cost supplier. But in the end, it'll be the lowest cost available reserves that will come to market most successfully in this environment. And until demand gets a kind of a bump from relatively low prices, that'll be the scenario. So it's a push towards lowest cost producers, most favorable economic supply terms, and so on that are going to be what suppliers are going to be focusing on right now.
And when we take that, we sort of think of the group of OPEC, OPEC plus, and their outlook for the year ahead. Inevitably, they turned a different direction last year from essentially a cutting cycle to then a increasing, returning those cuts, if you like, back to the market, or certainly eight of the OPEC plus countries, and now they've started the 2026 as a pause to stop increasing quotas, stop increasing supply, and pause for the first quarter at least. What are your thoughts? What are your expectations for OPEC plus and their strategy for through the 12 months? We've got their first 3 months, but where do you think they go for the 12?
Yeah, that's a tough one to project. I think if demand gets a bit of a boost with these relatively lower prices we expect to see, that could create a bit of space for OPEC Plus to bring a little more to market. I could see that being a scenario. Again, our demand forecasts are rising, others are as well. It's actually worth remembering what a remarkable achievement that was to bring that supply back to market and not completely obliterate the headline price. I remember in 2024, there was a lot of debate about had OPEC Plus missed its opportunities to bring oil back, when was it ever going to be able to get it done? And actually, bringing that oil back in 2025 without really disrupting the markets too much is quite an achievement if you want to think of it that way. So I don't think it's a surprise that OPEC Plus is now taking a step back to observe the impact, see how the market evolves from here. But if demand moves up a little bit, I could see that creating a bit more space. In a sense, Sean, what we're talking about here is market share is back. I don't think that defending the price is going away, but market share is back as a concept.
Do you think, just to sort of push on that a little, do you think we're in an era shifting moment in the sense that, for much of, OPEC exists by most sort of third party analysis as essentially a maximized price strategy organization. They would call it balancing the market, but ultimately they have been for many years focused around that maximized price, and now shifting to one where the lowest cost producer, the maximized market share. Now, we haven't completely made that shift, but you say market share is back. Is this a transition or is this a moment?
It's a moment for me, Sean. It's interesting. OPEC is the best organization to say what it stands for. And I take what
Sure.
OPEC says about what it stands for as, they say what they stand for, and I sort of willing to sort of listen to what they have to say about that, right? When we go to Vienna and hear what's on their minds. But I think of OPEC as being more about revenue maximization as opposed to price maximization for member countries, for the people who live in those countries. I think, for me, thinking about the history of the organization, it's at least part of it is about ensuring that the folks who live in those countries are benefiting from the natural resources, right? And that's not a particularly controversial idea if you live in a country that has natural resources. But if we think of revenue maximization as being perhaps some sort of a goal there, you can achieve greater revenue through either the price being higher or your share of the market being higher, and therefore these are complementary ideas actually. And I think that the relationship between volume and market and the price that you're getting will be a kind of a balance that OPEC Plus and others will continue to be thoughtful about, really. But I expect to see high cost producers get knocked out of the market this year, and I think that'll create a bit of space for OPEC Plus as well.
Higher cost producer. I mean, just I was going to come to that next.
Yeah.
Obviously, big news this week in Venezuela, but the Americas as a whole, obviously a higher cost producing region. We've seen a little bit of the steam come out of shale and the U.S. Main, onshore, the sort of mainland or the lower 48 or so on, has it's although there was records achieved this last year, but incrementally growth there. Where do you see that outlook, the Americas, but the US in particular as the world's largest oil producer, its outlook to sustain at lower cost production?
Yeah, lower prices create pressure on high cost producers in the US, in Oceania, like Australia. There are some Canadian high cost producers out there. I think if I remember rightly, some of the highest cost production in the world can be north of the border in Canada, in certain areas, not all areas.
Tar sands, obviously.
Yeah, exactly. So it creates a lot of pressure on those producers who've been very financially disciplined in the last 3 or 4 years. They've been careful not to overextend. They've, I believe, got some reasonable hedging programs in place, and a lot of them have consolidated into stronger ownership that's more resilient in times like these. But you would expect to start to see U.S. production flatten and fall off in a lower price environment, which is why it's a little bit ironic in some ways that the U.S. administration has lower oil prices as a stated policy aim. But that's the nature of the beast in the U.S. is that ultimately the U.S. is looking for lower prices of gasoline and other parts of the economy. So it does put pressure on U.S. producers, though.
And with that, you would think the big news of the week, of course, Venezuela, the potential for that opening up as an opportunity. Once again, when we were running around chasing oil ministers 25 years ago, Venezuela was producing 3.5 million barrels a day, now well below a million. So clearly there's headroom there for that to grow. But under these price points and these higher cost production windows in the Americas, it would seem a struggle to attract big money from the majors if we're struggling to get them into the Permian at these prices.
Well, of course, Sean, I'm sure it's been remarked upon by other guests at your event, but I'll point it out in case it hasn't. Not all oil has been created equally. Venezuelan oil is very special in that it's heavy and sour, particularly in that it's heavy. Venezuela currently accounts for 1% of global oil production, but it accounts for 9% of global heavy oil production. And so if I was running an oil major, I would, and I'm not for the avoidance of doubt, obviously, right?
In
but
my
I would be
spare
thinking,
time when I'm not
yeah,
sleeping.
exactly, on the side of my desk here. But I would certainly be paying attention to the fact that Venezuelan oil is quite special. And if it can be brought to market, it has a very compelling intrinsic value for U.S. Gulf Coast refiners. And if you put Venezuela and Guyana together, the rise of the Caribbean as a near-shore supply source is directly aligned with U.S. administration policy over the eras, by the way, not just under the Trump administration. So a powerful basin in the Caribbean, which Guyana and Venezuela together could be, along with Colombia and other producers. Well, that's a scenario that's got to be pretty interesting to any investor. At the same time, the amount of risk associated with that, government risk in Venezuela, government risk in the US, what's going to happen in the midterm elections here. There's a trade-off there. But, international oil companies have been risk friendly for 120 years. So I got to think they're looking into
How much of that 1 million barrel a day demand growth that you are seeing this year could be taken up by Venezuela's increased supply?
I'm going to say to you, none of it.
None of it.
Yeah. I don't think Venezuelan production comes back until 27, 28, 29. If, and that's a best case scenario where people are confident to invest. The new structures in Venezuela somehow are on a firm footing.
Well,
And
apparently there's 50 million barrels on their way to the US at the moment, as sort of a happy
yeah,
birthday gift.
yeah, that's right. But we shouldn't forget that most of that oil is going to China already, so it's
Yeah.
only being redirected on the water. It's not like they found it down the back of the sofa or something.
Yeah, yeah.
Yeah.
I given the other big dimension of this year of the 25 into 26 transfer. Obviously, we're just talking there Venezuela and a lot of very dramatic events in the last week. Dramatic in the headlines, but ultimately, at the end of the day, everything is sort of seems to have remained the same except for the leader. But the geopolitics were a huge part of 2025 on all fronts. They continue to be a big feature of 2026, and obviously, as I said, punctuated by the events last weekend. But yet, like 25, not really having much impact on the oil price, on the markets as a whole. Obviously, your
Yeah.
thoughts on where geopolitics go in 2026?
Yeah, it's easy to forget that in 2025, the US bombed Iran, for example.
Yeah,
Because like
and
it's
significant bombs, like
that
the
that
biggest in the box.
that was, I mean, yes, not yes, very significantly, right? And yet we forget that because, well, some people forget that. I'm sure folks in Iran don't forget that and elsewhere, but because the price of oil didn't move, the world moved on. Thank goodness there wasn't a massive deterioration of the security situation around the world, along with all the things that were happening then. So, geopolitics and the impact of geopolitics on the price of energy has been very muted since 2022. The last time the price of oil, natural gas, or anything had a significant movement in response to geopolitics was when Russia invaded Ukraine, of course. And that's because it had a direct impact on the way energy was being supplied into Western Europe and the EU. These days, with the supply demand imbalance we talked about at the start of our discussion today, that creates a natural buffer where if you ultimately, the effect of geopolitics on energy markets is how it affects supply or demand. Most of the time, how it affects supply. There is no single geopolitical event anywhere in the world on its own that can tip the market into deficit.
I wanted to wrap up with the taking that point and looking at global benchmarks. Are given this scale of geopolitical intervention, which ultimately is nation states and governments intervening into big events and into the markets, and like events that we're seeing in Venezuela, the U.S. government taking some kind of renationalization of the oil industry in Venezuela under American wings. But are global benchmarks still converging prices, or are we moving towards a more permanent regional pricing regime? Your thoughts on how all of these events and where they're intersecting with the global benchmarks, which of course you are the curator of many of the most important ones.
Yeah, thank you, Sean. We're very proud of the Platts benchmarks that we have in S&P Global Energy and the role they serve in the market. And there are, plenty of benchmarks out there folks are looking at. Our view is that benchmarks must reflect the value of the commodities they represent. That is the core purpose of a benchmark. We are very strong believers in that. We talk about that every day. To your question, I don't think that global benchmark prices have been massively regionalizing or diverging over the past 5 years. In fact, if anything, they've been moving kind of broadly together, up and down and through time and in terms of market structure. And that's a sign of an efficient market because in the end, the commodities we're talking about today, oil, gas, we haven't talked a lot about NGLs, but that's a big part of the market, propane, butane. Those are internationally traded products that move from suppliers that have too much to consumers that don't have enough. The key part there, Sean, is those move through a global balancing market. And so if that global market is functioning effectively and the regional markets that depend on them are efficiently tied into the global marketplace, everything should clear and balance together. There will be movements in the Brent Dubai spread. There will be movements in the natural gas price versus crude oil. That should reflect what's going on in terms of, day to day, week to week, month to month swings in demand. But, unless there's a complete fragmentation of the global economy towards the 19th century standards of behavior, I wouldn't expect to see benchmarks get walled behind big cities.
Well, we're going to have to wrap it up there. It's been an absolute pleasure, Dave, to catch up with you. We're really grateful that you could carve out half an hour with us at the Global Energy Outlook Forum 2026. Really useful insights for all of our stakeholders, all of our audience to be presented with. So thank you very much, Dave Ernsberger, President of S&P Global Energy.